You are listening to Bitcoin Standard by Saifedean Ammous. Let's talk about what happens when governments start printing money like there's no tomorrow. Picture this. You're living through the past century, watching economic chaos unfold repeatedly. What went wrong? We abandoned something that worked for centuries: sound money. Here's the thing about money that most people miss. Your wallet contains more than just payment tools. It represents trust, value storage, and economic stability. Without reliable currency, we'd still be haggling chickens for shoes like our ancestors did. But here where it gets interesting. Take the Yap Islanders. They used massive stone wheels as currency, some weighing 4 tons. These rye stones worked brilliantly because everyone could see them, own pieces of them, and trust their value. The system collapsed when an Irish-American captain flooded the market with machine-imported stones. Overnight, money became worthless rocks again. This pattern repeats throughout history. Julius Caesar started with solid gold coins containing 8 grams of precious metal. Roman emperors gradually shaved metal off these coins to fund expanding government programs. Sound familiar? This coin clipping eventually triggered the economic crises that toppled Rome itself. Fast forward to the 1700s. Isaac Newton established Britain's gold standard in 1717. By 1900, 50 nations had adopted this system. Paper money became trustworthy because gold reserves backed every bill. This created what economists call sound money, currency chosen freely by markets, not decreed by governments. The Golden Age literally began. The 19th century witnessed unprecedented prosperity and growth. People saved more because money held its value over time. Investment flourished as stable currency encouraged long-term thinking. Capital accumulated steadily, creating sustainable economic expansion. Then came 1914. European powers needed cash for World War I. Rather than raise taxes, they chose the easy path: fire up the printing presses. Within weeks, paper money lost its gold backing. The Austro-Hungarian krona plummeted 68.9% against Switzerland's currency, which stayed gold-backed. After the war, governments faced uncomfortable choices. Return to honest gold valuations and admit their currency's true worth. Impossible, too politically damaging. Instead, they introduced fiat money currency, backed by nothing but government promises. The Bretton Woods system in 1944 attempted a compromise. All world currencies would tie to the US dollar, which would tie to gold. Countries shipped their gold reserves to America for safekeeping. This pseudo-gold standard couldn't survive reality. Nixon finally severed the dollar's gold connection on August 15, 1971. What followed was predictable disaster. Without sound money's discipline, governments manipulated currencies freely. Central planners lacked the information needed to make wise economic decisions. Boom and bust cycles became the norm as artificial money distorted market signals. John Maynard Keynes promoted the dangerous idea that governments should spend their way out of recessions. This required more money printing, creating inflation and encouraging short-term thinking. Debt accumulated as people stopped saving for the future. The culture shifted from patient investment to reckless speculation. Government intervention causes recessions, then Keynesian solutions make everything worse. Prices stop reflecting real market conditions. Investors can't make informed decisions without accurate price signals. Capital gets misallocated, creating bubbles that inevitably burst. Enter Bitcoin. Satoshi Nakamoto designed this digital currency with gold's best qualities, but none of its weaknesses. 21 million Bitcoins will ever exist, period. No government can print more. No central bank can manipulate supply. Bitcoin mining mirrors gold extraction perfectly. Early Bitcoins came easily, but each subsequent coin requires more computational work. The system automatically adjusts difficulty as more miners join. Bitcoin issuance halves every 4 years, creating predictable scarcity. The blockchain provides unprecedented security. Every transaction gets recorded publicly across thousands of computers. Cheating requires controlling most of the network, an impossibly expensive undertaking that would destroy Bitcoin's value anyway. Bitcoin faces challenges. Price volatility reflects its newness. Demand fluctuates wildly, while supply stays fixed. A single Bitcoin jumped from less than 1 cent to over $4,000. This volatility should decrease as markets mature. Scalability presents another hurdle. Bitcoin processes limited transactions daily. Growing adoption might require centralized institutions to manage Bitcoin-backed currencies, potentially recreating the problems Bitcoin aimed to solve. Despite these challenges, Bitcoin offers humanity's first chance at truly sound money since the gold standard's abandonment. It combines gold's scarcity with digital convenience. No government can debase it. No central authority controls it. We stand at a crossroads. Continue down the path of fiat money, boom-bust cycles, and endless debt. Or embrace technology that could restore the prosperity our great-grandparents enjoyed under sound money. The choice seems obvious when you understand what's at stake. Found these insights valuable? Hit like and subscribe for book summaries that could transform your thinking. The purchase link for the Bitcoin Standard is waiting in the description, and we're curious, which of these concepts resonated most with you? Drop a comment below.